Good jokes. Um, 85, which is pretty normal. They did re-tag 1 to 80%, one of the bands to 80% last week. But the rest of them at 85 or 90%. And
Talking about crazy.
yeah, the hurricane caused a lot of problems with seedlings, late things like that. Can affect seed bean quality. So a lot of our beans have came out of Illinois because of that. But yeah, I mean, supply still looks good. Just I have to fight through some of them.
You said the beans look terrific.
We got a shitty line on your face.
I hope you're kidding.
400 loads of all. If they're buried.
400 loads of mulch. Mother's burying it. So
They're buried. Key. All about it.
so then you're
Buried.
you see that this morning, Rose Acres broke with Asian swine.
Yeah, I'd heard it yesterday and saw the article stuff this morning. It's been hit pretty hard in west central Ohio too. None of them quite as big as the Rose Acres one, but there's a Cooper's at a place up there with about 1 million birds, and then Mercer Landmark's got another one. Yeah, so it's
Real.
yeah, it is. It sure is.
Storage, you know, deep bag.
Yeah, no kidding.
Yeah.
Well, yeah, no. I guess maybe it's a good thing eggs are somewhat perishable versus like toilet paper and COVID when people stock like, oh, I can just stock up on a year's worth.
Man.
At least maybe that keeps people from like going and buying like 20 dozen eggs because they're not gonna. But yeah, it's
That keeps, they're on, it keeps it working.
yeah. Yeah.
So I guess it makes sense to buy a chicken coop and a dozen chickens, right?
Mm-hmm.
There you go. It's your next endeavor, Roy. Yeah. Yeah. Yeah.
Yeah.
But that's a lot of birds.
Yeah.
That's what Barron was talking about, trying to get it to spread them. Spread it as compost, the dead birds. Probably wouldn't be up my avenue, but
Yeah. How's the disposal for that work? Any idea?
I'm sure they've got as part of their permit, they'd have to have a catastrophic disposal plan.
Yeah.
I would assume they would be burying them, would be my guess, or composting them of some type,
Yeah.
or rendering. That's a lot of chickens. So
Yeah.
Chicken nuggets probably gonna go on sale.
they could, yeah.
So you compost them for a while and then eventually it gets hauled out.
Yeah, which I mean, we compost my pigs on my farm, and
Yeah.
just you throw them in, cover them up with sawdust, and usually takes about 6 months. And there's really nothing left of them besides sawdust.
I
So it's just a compost material.
Yeah.
Believe it or not, we don't have problems with them.
Really?
Yeah. Yeah. You just got to keep them buried. It's the key. Yeah. Yeah. I used to like composting or burying them is approved disposal methods, or rendering one of those options. So
guy I used to work for just used to dig a pit and throw them in and stand out with a rifle and shoot the coyotes.
Nice. Yeah.
It was a lot more fun that way. That's right. You still got pigs in the barns? They empty.
They're empty.
Yeah.
Gotta figure out what to do with the buildings now.
Chicken,
Not gonna be chicken.
chickens,
Wow.
chickens. Are they in decent enough shape yet or?
Gonna be a lot worse.
Yeah.
Okay.
Slats okay still?
Yeah.
Yeah. Yeah.
Yeah, they're too small for
Yeah.
pigs.
Yeah.
nowadays.
Yeah, for today's production. Yeah. Because they were, how big were they? 250 head, 500 head buildings? I forget. 400. Because the growers were on one side. Okay.
They were-
Yep. Grower on one side and finisher on the other side. Yeah.
Each one was 200. We moved them from the
Mhm.
grower to 200.
Oh, I remember. I remember those days.
Yeah.
Yeah.
Yep. 200.
Yeah.
Oh.
Yeah. Yeah. It's a lot different today. Fish. Ever thought about fish? Could do that, couldn't you? Tilapia, farm raised tilapia. They tried that over here, didn't they? Farm raised fish, tilapia. Didn't they have tilapia there on 800? Yeah.
It's hard to do it. We tried to fish and talk about livestock, and now it's a wedding.
Yeah. They're making more money now than before.
All it is is more than that. You charge $10,000 a week. It's a great, it's not very.
Pretty good gig.
Yeah.
Yeah.
We've got one more downstairs. We'll get him up here in a second.
Don't try to get it off the chicken, lawyer's property.
Nathan, I've got it on the speaker. So we're gonna record on Zoom. So just flip it to your shirt or something, but I'll say a few words so that that's audible and I can just hand it off to you.
Oh, okay.
Yeah, Travis will do most of the.
Okay. Yeah, he's got one as well. So
Yeah. Buildings and quality.
Well, you know my son, Anthony.
You don't know if we were getting or not. Nice to meet you. It's been a while. You were my mentor, Dave.
Family doing all right? Family doing all right?
Yeah, fine.
Back in the swing of things after Christmas break and
Hey, thanks, Greg.
for snow and all that crap.
Big in basketball, I just played in soccer.
sorry, sorry, just I was in here.
Labels.
I've last year,
Lady in Batesville that'll undo that.
really?
Yeah.
Well, what I'm gonna do instead, I think, is just get a different patch and put on there. I just.
You can do that too.
Yeah, like,
Just,
I mean, I could do the interactive ag logo, or I might just do like a national parks, some sort of logo, just something. But last year I had gone out and visited a customer, like in December and January, I was like, man, I mean, I have a different bag. I just liked this one. I'm like, I gotta get some ordered ahead of time and didn't have it. And then I got the swimming things. I'm like,
that's awesome.
but I'm kind of proud of it now.
It's like my ski pants, they're starting to get duct tape on them, you're getting cut up.
Oh, yeah. Yeah.
Ready to go,
Show
Bear?
my pitch training, right?
The Jess goes on the.
Guys, I think we'll go ahead and get started here. We're a few minutes behind, but we've got one more downstairs that's going to come up with Spencer, but go ahead and get started, guys. Thanks for coming today. Got a good opportunity here to talk about a hot topic in grain marketing. We've got some experts here in the room that can share their thoughts and opinions on what's going on in the market, and it's an ever changing and exciting place to be. Things are in the black today, it looks like. So that's encouraging. So hopefully these guys can share. So as we talked last time, we are going to record these and send these out. Our fearless leader, Brian, is out of town. So we get the opportunity to be here and speak with you guys. So guys, I'm going to turn it over to Travis and Nathan with Interactive Ag. They kind of give a little reference on who they are and where they come from. So here you go, guys.
Sounds good. Thanks, Rick. Okay, as Rick said, I'm Travis Algren with Interactive Ag. This is Nate Redding. We'll give brief background of where we each have been in our careers and what we do today before we dive into this here. So I moved to the area in 2008, originally from Western Illinois. Took a job with Consolidated Grain and Barge in Cincinnati, Aurora. So I've been in grain merchandising origination and in this area from here down towards Aurora for the last 15 years or so. November of 23, stepped out, joined up with Nate's business, Interactive Ag, and have a customer base now in Southeast Indiana, Southwest Ohio. Personally, our group total, we've got 5 advisors. We're spread in the Eastern Corn Belt. So pretty much all of Indiana, Ohio, a little bit of Southern Michigan and Kentucky is where we operate out of. But locally, I live in Milford, Ohio, so about an hour and a half east of here. And Jake Wiener's another one of our teammates. He's in Harrison with a customer base, between here and the river as well, and up kind of towards Union City and Greenville. And then Nate's also local, and I'll let him give his background and introduction here.
Sure. Hi, Nathan Redding, grew up Greensburg, went to North Decatur, so very familiar with the area. After Purdue, though, I spent almost 20 years out of state. Most of it down in South Louisiana, working with Zeno on the corn export desk.
Hey,
Come on in. So I spent quite a bit of time down there, and that's kind of where I really learned the grain markets, the way we handle them now. Then I spent a few years out in Colorado with JBS and their risk division, overseeing basically all grain risk worldwide for JBS. Not necessarily buying, selling for them, but traded kind of an internal hedge fund around their position and then advised their purchase teams around the world. So a lot of experience with export markets, foreign transactions as far as how grain flows. And that's since then I've left and just basically trade for myself and a small prop firm out of Chicago, and then built this business working with farmers, like Travis said, throughout the Eastern Corn Belt.
All right. Thanks, Nate. Well, we'll dive right in. So we're going to cover 3 main things today. Number 1, a review of the January S&D report that came out last month. Now, that was a pretty big game changer for corn. So it's important that we discuss everything that was entailed there. And secondly, 25 outlooks and targets. What are we looking at for next year? And finally, cash grain analysis. So that's basis. What's it look like for the U.S. as a whole, and then specifically in our backyard here. Okay, we finally got a friendly USDA report, right? It's nice to get one of those. Doesn't happen too often. So what do we see in January? Well, first of all, yield was down 3.8 bushels on corn. You can see we went from a 183.1 in December to a 179.3 in January. Really big drop. I mean, personally, I didn't expect it. I mean, we were leaning on the side where we might see a slight reduction, maybe a bushel or bushel and a half, but 3.8 is a huge number. And obviously it caught the market by surprise. We pretty much went up 15 cents immediately after that report came out and have held pretty well. We gave a little bit of it back here the last few sessions, but have held pretty good. What else did they do? So I guess that ended up with supply down 273 million bushels. Also increased demand. So if you look back at the November report, we had demand at 14.99 billion bushels here. And today we sit at 15.115. Most of that is through exports. You can see here 2.45 billion today versus 2.325 in November. Nate, what's your take on exports? This is the biggest, or let's see, the 3rd biggest one, I think, in the last 15 years, roughly. So do we have room to add to that a little bit more? You think this number's maxed out? Where do we stand today?
There's some holes you can punch in it either way. So you've got USDA, I think, is at 14 million tons for China. They haven't bought any corn here from the U.S. for I don't remember the last time they bought U.S. corn, but there's 7 or 8 million tons of fluff in that number if China doesn't perform here in the U.S. That doesn't mean they don't buy Brazil corn, and it kind of moves everything around. If they take it out of Brazil, that means somebody else has to come to the U.S. and offset. But the big question is really, is China coming back to the table for corn or not? at the low $4, high $3 price, I think they would have. At these current prices, their import margins are not that strong. They've got some domestic problems, both economically as well as just they've got a large supply of stocks and reserves that they've built since 2020. And they've been trying to support domestic price to increase domestic consumption for more self-sufficiency. So coming to the world market at these prices, not necessarily something they're interested in doing. So there's some wiggle room in that number. The flip side of it is the EU had a bad wheat crop, had a bad corn crop. Black Sea had a bad corn crop. And we don't know how much the EU will import corn as a feed substitute. Right now, wheat pricing so low below corn, the EU's using a lot of wheat for feed. So with that wheat corn spread fairly narrow here, I think that number has a hard time going higher. Late summer, depending on how Brazil safrinha comes off, July, August, Sep, that will determine how much that number can change. But
And so we find that out come, say, June.
We'll start
unless
really
there's some
getting into it March,
unless there's
April.
some, like, clear cuts in their production that you
Sure.
might know of earlier, but they really ramp up. What is it, mid-July, you say, on their safrinha
Late
exports?
July's harvest, August,
Okay.
September shipment. They're planting it right now behind, I mean, as the combine rolls through, the planter's right behind it, planting corn in northern Brazil. So they're 3-4% harvested on beans, which means they're about that much planted on safrinha.
Yeah, so there's been some chatter recently that they're behind harvest pace on beans in Mato Grosso, so therefore they're behind planting pace on their safrinha corn. But from what I've read and been told, there's still some time to play catch up, right?
It's early.
Yeah, it's early. I mean, there's still probably 4 weeks of catch up time before the market needs to get too concerned about that. So that's a headline you'll read some of, but I mean, I wouldn't, go out and get all bowled up just because of that alone right
It's
now.
very hard to handicap that crop, I mean, within the first month of planting.
Okay, so what was I guess the final carryout drop here for USDA on corn, January versus November? We're down
Almost
about
200.
398 million bushels, so 1.5 billion carryout. It's not crazy tight, but it's tight enough that it's definitely a story. It's the tightest we've been in a while. We got up pushing 2.5 billion carryout a few years ago, so it's fairly tight now. It's kind of mid-range, I would say. Do you agree with that, or?
Yeah, we're sub 10% stocks to usage. So you see it in the summer months, July, 30 cents over December futures. The market's expecting a very tight window to finish the Northern Hemisphere shipment season before we get into our harvest. And as that number ebbs and flows, that becomes a lot more of a direct indicator of what the back month spreads will do. And if they're going to be really strong, flat price generally follows.
I think it's just interesting to take a look back at where they started this year. So you go back to the May report, kind of crazy, but they damn near pegged production spot on. I mean, ended up with 14.867 billion bushels versus 14.860 on May. So that's kind of crazy. After yield was raised way up and then cut back, but they ended up very close to the original number. But you can see here we've had exports grow, like we've been talking about, 2.45 billion bushels. That's quite a bit higher than what we started with. But overall, ending stocks have been cut 562 million bushels versus the first number that was used in May. So that's been a nice, pleasant surprise to the corn market. Well, last point about that though, corn price down 20 cents from where it was in May. So I don't know, a bit frustrating, but also in May when this report came out, that was about right at the contract high for the early summer, short rally that we had. Just a graph to show exports. You don't need to spend too much time on this, but the blue bars, you can see we are ahead of pace for USDA's number. That's the orange dotted line in the middle. So like Nate was saying, he doesn't think that number will increase, but we are a little bit ahead of shipping schedule as far as export sales or this is sales pace, not actual bushel shipped, but we're doing good so far. So what has price action done? So we talked about the May high here. I actually recall last year a big portion of, we were here in January or February last year, and a lot of what I covered then was that 19 out of the last 20 years, the market had revisited the January high and exceeded it sometime throughout the marketing year. Well, sure as shit, now it's 19 out of the last 21 because that didn't happen last year. So that's a big part of what we were banking on. The market had gone down pretty heavily January into March, April, and we said, all right, we want to wait for, now that we've lost this much, let's wait for a May, June move higher in the markets. 19 out of the last 20 years, we've exceeded the January high. Well, sure enough, didn't happen last year. As you can see here, market tried making its way back up there, but we never got as high as where we were in January right here. It was actually the first day of January was the first trading day. January is the highest number we saw all year. So extremely frustrating markets. But now on the way back up, had a really nice breakout here. You can see 460 was really, really stiff resistance here. It was struggling to break through. I mean, personally, in hindsight, yeah, we started a little bit early for our group. As we came into this level here, we made a small amount of sales. We hit it pretty heavy in that 440, 450 range. But I mean, you can see the market revisited that a number of times and was struggling to break through it. And when we came from, a $4 low type level, I mean, and finally got some positive business returns. I mean, it made sense to make sales. So that's what we did. But finally, with the help of the yield cut on the January report, we're able to see corn make a breakthrough here up into new highs, or I guess highs for the last 6-7 months. So what do we do about it now with old crop? I mean, we think we need to be still selling old crop. We like being anywhere from 70 to 90% plus sold on old crop. I mean, depending on the customer, some customers, if you want all your cash flow by March, 100% sold out, that's fine. We went there on this recent rally with some people, for those that will carry some bushels typically into that April, May, June, July timeframe. Yeah, we're still holding on to the last 20%-ish of the crop because there is a story in corn and the carryout's fairly tight. So I don't know. I personally don't see any sustained continuing rally here over the next few months. I think the market's done enough work for now. But like Nate was saying, if we get into May, June, July, and if there's any sort of weather issue with the safrinha crop, that's when we could potentially see the next leg of excitement. So, well, I kind of jumped ahead a little bit here, but how high can old crop corn prices go? Well, let's take a look back at years where we had a similar carryout. So 21-22, 1.54 billion bushel carryout was printed on the January USDA report. 2021, very similar number, about 1.5. And that's what we printed this year. So we're kind of in the ballpark where we were those years. In 2021, we're at 485 in January, 21-22, 592. I would say we had a lot more exciting or more of a big picture bullish story going on in both those years. 2021 was when China came back in and bought everything. So we're not seeing that now. Nate already discussed that. 21-22, you still were kind of on the back end of China coming back in and buying everything. And that's when you had the Russian invasion of Ukraine, and we just outside money flowing into wheat, flowing into corn. So we had a couple of really big stories there that we don't have today. So as you can see with those years, we ended up, this was the final carry out to use ratio. Those years, we ended up getting those tighter than what they showed on the January report. We just kept increasing demand. And, as you can see here, we were looking at a carry out to use ratio of about 8.5% back in 2021, or about 9%. So not terribly higher today. We're around 10.5%. It's getting down there, but we're still higher today than where we ended up those years.
Well, it's a very asymmetrical relationship, though. You start to go sub 10, your price responds in a much higher magnitude than if you're 10, 11, 12. You're in 10, 11, 12, you got too much of everything. The world doesn't care anymore. the way they run this is they say, okay, we're going to empty Brazil, empty Ukraine, empty Argentina. The US is the reserve holder of corn. Whatever's left there is the stocks to usage. Well, if we start getting 10, 11, 12% stocks to usage here, and you got another crop coming every 3 or 4 months, then it's not that exciting. But when we get into that 8, 9% window, we have these explosive markets. We're in such a dynamic, headline-driven world right now that would be the fear of being short is you get a major change in policy. China has to make friends with the US, come back like they did in 2021, 22, right? That kicked off, they went from 0 to 20 million ton of imports. Right now, they're back at 6, 7, maybe get to 10, but they have a much different economic outlook now than they did then. So it's a lot of unknowns here, but it's important to understand this relationship as you kind of make your decisions.
Yep, absolutely. I mean, you can see we're in a different world now than we were in the very high oversupplied years of 14 through 19. You know, we were up there in that 13 to 15 stocks to use ratio percentage, and you know, as we all remember, I mean, prices were just stuck low for a while there with nothing exciting going on. Okay, let's take a look forward at 2025 crop corn. Trend yield should be 182.5. I don't know. There's now what we've had 5 or 6 years in a row. We haven't hit trend yield. So can we? I don't know, but that's probably where USDA is going to start with their numbers. So, I mean, they'll probably print some carry out. I'm guessing, you know, pushing 2 billion bushels. What do you think, Nate?
I mean, we don't know acres. So acres is a huge discussion between now and the end of March. Your big grain companies are anywhere 93, 94 million acres. A lot of it's heavily dependent on the corn bean ratio and how the South American crops finished down there. I would say we should use somewhere around 93. Probably market will trade a 181. USDA is going to print higher, but the market will probably not trade it.
Yeah. So here's a middle column as 93.6. So that's about the acres Nate's talking about. Now we put a 177 here, but they're probably going to show something higher than that.
Well, you use 181, that's a 250, 270 higher or something.
Yeah.
So it's a quick return back to positive over 10% stocks to usage with a good Northern Hemisphere crop. And Ukraine, you got to remember last year, Ukraine was down 7 or 9 million tons. They come back with a good crop, which it's very hard for them to have a bad crop just based on their dirt, their climate, and how they operate. It's very rare for them to have 2 bad crops in a row. The safrinha crop is very important. So it's kind of the stages, safrinha, U.S. acres and Ukraine acres get planted, and then U.S. growing areas. So between now and April, May, we're going to go through these cycles. And that, if we start to get comfortable with world stocks, then new crop prices $4.80 to $5, or where are we at? $4.60 to $4.70, or start to look fairly frothy. But you still don't know what trade policy does and some of these other outliers that are impossible to predict.
So today, you know, we've gotten started with most customers, you know, 20-ish% for new crop. I mean, more conservative folks are less than that. You know, a few of the more aggressive folks are higher than that, but that's where we're at with most folks in that, you know, 445 to 460 range here. We hit one early sale back in September, then did it again more recently in the mid 450s. Market's been kind of stuck around 460 here the last week, but thought process there is, you know, with APH or better yields, we've got to return to the business. I mean, is it what we hope for? No, it's not awesome, but you know, it's something. It's a start. It's a positive return. We're showing on corn and we're not showing that on beans. So we think it's a good idea to get started with that amount. Where could it go this summer? Like Nate says, if we've ideal conditions in other growing regions, you know, we might be stuck 450, 460 might be a little high, and, you know, could drift down to the 420 range. But if we've got an issue with the safrinha crop, or like an issue in the early growing season, you know, the market likes to kill the crop once in the US usually. I wouldn't say that $5 is out of the question for December futures to get to in that May, June timeframe, but there's obviously no guarantee. You know, I think we have to see things line up right. And if it gets there, I think we would likely hit it pretty hard.
Well, you gotta be, I mean, my mind is saying if we're at 93 million acres and we start to get numbers that show at trend line yield, 140, 150, 160 return an acre, it's really, really important, I think, to understand where that is. Because if China stays out of the market, Ukraine comes back with 7 or 8 million tons normal crop that they didn't have this past year, the supply shock is gone. Now we have to get to encouraging demand, and you don't do that at $5 corn. And so if you could start to build a base there, and let's fast forward, everything stays status quo with China, you should go back to a carry structure market. Well, that carry is only advantageous if you've got hedges on in a good spot that you can roll out to make your space make you money. So that's why we're looking at, okay, we can get 460, 470, hopefully get into a chance with a decent basis, get 15 cents rolled east of March. We start to edge up into a number that returns to the bottom line. But it's not, there's no layups right now. It's so much volatility in trade policy with the new Trump administration, and with China's economy is looking sick and sicker all the time. You got to be really careful saying they're going to come back. They're going to come back because we don't know. They're raising a 300 million ton crop. They're getting close to self-sufficient.
All right, so those are the U.S. numbers. Let's take a look at world corn carryouts. So we'll start with looking back a few years. So in 21-22, we had a world stocks to use ratio of 25.4%. See up here. On January 15th that year, corn was around $6. Then 22-23, we had a 26.9 stocks to use ratio. Corn price was $6.70. Last year, in mid-January, we had a stocks to use ratio of 26%. Also, corn price was $4.50. Like we harped on a little bit ago here, the China story was gone. The Ukraine invasion story was old news. We're back to really nothing exciting going on. So we have similar stocks to use ratios around the world, but we don't have any big bullish story to really bring outside money into things. Funds had pulled out of the grain market. They were a little bit more short. Where do we sit today? 23.7% stocks to use ratio. So we're actually tighter. That's the bullish side of the story in corn right now, is we have brought down world carryout a little bit, but like Nate says, we're not that. You're always just a big crop away in Ukraine or in Brazil for the safrinha crop to making things a little bit more comfortable again. Here's a chart view of that. So the orange line is stocks to use ratio. You can see we're hovering around that 26%, and now we're down to that 23, 24. That's the main reason why we're at 450, 460 corn now for new crop and old crop in that 480 range rather than down at the 420 level. Just had a tighter crop in the Black Sea, and we've had good world demand. I thought that this was interesting to throw in. This is world less China corn carryout. So the main thing I want to point out here is that the world stocks to use is 23, 24. Without China, it's at 8%. So point is, China holds the majority of the stocks around the world. That's like Nate was hinting at earlier. That's what they do. They have big reserves. If they're comfortable and sitting on them for a while, you don't see them come to the market. At some point, they might come in waves and refill, but we don't see that happening today. That was a big move they did back in 2021. Quick chart on D's 25 corn. 460 was a major resistance point, and that's why we suggested some sales a little bit below that. You can look back and see that the market peaked out there late summer. Again in September, it peaked out there. We fell quite a bit, down to 430, and then once we got up close to it again, that had been a major resistance level. So we looked at some additional new crop sales there. Finally busted through that a little bit here in the last week, but we've fallen right back to that level, as of today. When I put up target range there, that's today. I mean, obviously that can change tomorrow with policy or anything. We're constantly reevaluating that. But, today, if we've gotten a start on anywhere from, 15% done with conservative sellers, or maybe 20 to 25% with the more aggressive folks. We're probably going to sit a little bit and see how things progress with the idea. If we see corn in that $4.75 to $5 range, we're definitely going to want to make more sales there.
Yeah, I think we gotta, if we could get in there, we gotta understand why. And then,
Yep.
like, why'd we get there? What's
Yep.
going on?
Which way is the
the
wind blowing now that we're here? Yeah.
Yeah, but I just keep coming back to the world is growing more and more every year, and that demand with China got us from 20 till here. We had those good years because they were buying 20 to 25 million tons for reserve stocks. They weren't using it. They were putting it in storage. They were holding it back. Now we don't really know what their usable stocks corn is right now. I think you all know what 3-year-old stored corn does to when you're feeding it. And having spent a lot of time in China, they're not storing it in nice upright bins all the time. So there's some question of how much of that corn's usable, but they're gonna force it out. They're gonna rotate those stocks, but they may not go as big again unless they're forced. They know that's a card they can play with the US. And so I think they've been holding it and will continue to hold it. Trump may negotiate something and we wake up tomorrow and they're buying 20 million tons again. All this is off the table. The market's going up. But it's so binary in that regard. You gotta, that's why I like 20, 25%, not 50 to 80%. Or if you're going to do it, there's min maxes and there's other structures you can put around to give you a glimpse of some of the upside. But strip that away, grow a normal Ukraine and Brazil crop, all of a sudden we got too much corn again and we're back where we were, what, a year ago. And so it's like, look at your business. And if I can lock in a positive margin or go to a negative, I mean, it's a very asymmetrical risk profile.
Okay, let's look where the funds are in the corn market. Numbers printed on Friday afternoon, long 312,000 contracts. So this is 300 right here. It's just amazing. Late summer, short 350,000. I mean, right at a record short. And so they've covered, what is that, 550,000, 600,000 contracts in a matter of 6 months. I mean, just an unbelievable rally.
And the farmer sold it to him.
The farmer sold it to him, and that's why the market has gone up. I mean, we sold it to him as advisors, and a lot, I'm sure this room sold it to him. So that's why the market has gone up, what, 75, 80 cents, close to $1, rather than going up $2 or $3, is because there's been a lot of last year's old crop sold at the end of, August, September. As they started covering their position, there's been probably 65, 70% of this year's crop sold already also, is the numbers we're hearing from different grain companies,
Yes.
what they think has been sold from the general farm population. So now what happens from here forward, it gets interesting. Now that we're down to the last 30% of this year's crop to sell, does farmer selling slow down? And so, but also, do the funds have that much more room to add to their long position? Historically, the answer would be no. I mean, 350, 400,000 contracts, 400 is about the record. So, but on that last 100,000, if there's not a lot of farmers selling, maybe if they did push it, this is all hypothetical, but let's say farmer selling dried up. I mean, there's times where the funds have bought 100,000 contracts and the market moves $1. I don't think that happens this time, but I just want to try to look at the relationship between when the funds are buying, how much farmer selling and hedge pressure is there to slow the market down as they buy versus are they buying into a vacuum? And that's when you really see the market shoot up when they buy. That's more like what you see, in these years when you get like your early June rallies, and the funds go long. Okay, you're mostly out of old crop a lot of these years, and you're puckering up because your crop's this tall or not out of the ground, and it's June 20th, and that's why we see those explosive moves there. But I mean, you can see they typically don't spend that much time long, 200, 250,000. I mean, look at all these arrows. It's a short amount of time. The extended ones are, of course, in the ethanol boom, the drought of 2012. And then here, the last couple of years, 21 and 22, we already talked about those reasons with China buying and the Ukraine invasion.
So the question
point
I
or
have is, who are they going to sell this to? Or you probably going there.
Yeah, who are they going to sell it to when they get out?
I mean, if you're a fund and you're buying corn today, you intend on selling it at a higher price on another day. Somebody else has to then at that point in time either be getting blown out of their short or have a desire to take that risk on at that price with the idea that they're going to sell to somebody higher. And it's just, I mean, eventually you get there and there's like, they go to sell and there's nobody home. And that's why you get the stair step up, elevator down. And my concern with this structure is farmers don't blow out of shorts. You sell your grain to the elevator immediately puts the short futures on, offsets the futures. They do not care about which way the futures are going. There's zero delta on their futures position. They're basis traders. So if you look at the progression, the last 4, 5, 6 weeks, it's almost been 1-to-1, commercial short, fund long. And then this last week, we saw the non-reportable long increase dramatically. And that's kind of your doctor, dentist, shoe salesman club. And so the non-reportables are now taking on length at these higher prices in the past week. And I'm not, structurally, I don't know who's going to sell it to or who they're going to sell it to. Is the end user going to get spooked and have to go in and cover more days of usage? Today, talking to my old friends in previous life, they are not spooked. They're not worried about running out of grain. So that's the question I can't answer right now. And that makes me nervous from a market structure standpoint to get complacent with these prices.
Yeah, history shows anytime funds are long 250, 300, 350, definitely shouldn't be sitting back and doing nothing. Getting coverage makes sense. It's rare for them to spend a long period of time in this position. All right, we're going to shift to the cash market for a little bit here on corn. So when I say cash market, I mean basis. Job of basis is to get grain from a surplus area to a deficit area. Simple as that. And what's the transportation look like to get it there? So this is a pretty cool map. StoneX puts this together. They got a pretty neat portal we can get on and pull all sorts of information from. So what this shows is the change in stocks from this December 31st versus December 31st a year ago. So as an example, Ohio is showing 499 million bushels of corn as of December 31st. That's 99 million bushels lower than a year ago. So you look for the dark red and light red states, that's where we have lower supply this year versus last year. The blues and dark blues is where we have higher supply. So Ohio, crop was cut, pretty big drought in south central Ohio. Indiana, just down a little bit from last year. Iowa and Illinois and Kansas, considerably higher stocks. So when I think about the cash market, where's the deficit at this year? This map doesn't show the Southeast, but the Southeast had a shorter crop also. So rail basis is pretty strong. You know, like locally, Kokomo at Edinburgh has been like 9-10 under. That's not too bad considering, you know, Poet until recently has been 5-10 under as well. So the rail bid's just as, you know, has been just as good at Edinburgh as it has been at Shelbyville. That's corn going to the Southeast feed market. Big export number this year, 2.45 billion bushels. The river has a strong pull. We should see a little bit higher percentage of corn work to the river. River should have a really strong pull out of Illinois and Iowa. Nate, you've got a contact in Iowa who runs a wet mill right up in Iowa. He's the commercial manager there. He was saying there's enough surplus of corn recently on the higher futures move that they're just letting corn go by them to the river. Is that right?
In the last 2 years, they haven't let corn pass them, and they're letting it go to the river market as it is. They've got enough coverage to get into April, they think. And so you got a much squishier basis out here than we've seen in quite some time. And that in the last couple of years, that's been a big influence into your summer spreads. The Western basis has just completely pulled grain that direction. We flip-flopped it. Now the Southeast is going to pull it. But with the river, I mean, we've got a good export number, but most of that corn to the export market, 70% of the Gulf comes out of this little window here. The PNW comes this way in Nebraska. So the export market, who's really going to drive those inverses, has more backdoor corn than they've had in the last few years.
So our take on basis, we were aggressive, very aggressive, mid-November through early December. You know, harvest finished early this year. We got a pop in basis. If you're here real locally, you're probably too far to go to the river with corn. You're probably looking at Poet or Kokomo Grain, amongst a few others. But like river basis got to 5-ish over for January, around 10 over for February, 13 to 15 over for March. We hit that pretty aggressively, and it's since backed off. I think they're in the 0 to 5 over range now. Bushels getting stored out, planting and past. I think basis could get a little interesting. I mean, the export pull should be good, so I think the river should have a strong basis in April, May, June. I don't expect a whole lot out of Poet just because the crop was big in Poet straw area. I think there's enough to keep them going. Now there are places in Ohio where the crop was less. I mean, along the state line here, there's a heavy concentration of ethanol plants and feeders. I mean, they've had a strong basis all year. I mean, been trading 15 over type numbers into them the last few months. I mean, $5 cash specials, out of Greenville, Ohio, Union City, Indiana, Cargill, Dayton. So another interesting look at it here, on-farm stocks versus the previous year. So again, Ohio, quite a bit less, 70 million bushels less, shorter crop in Ohio. And it mirrors the last one, the same states for the most part, same color. I guess my point of showing this one is that, well, let's fast forward to off-farm stocks. This is probably brings it home here. In our area, you can see 30 million bushels less of corn in Ohio, 31 million in Indiana less, Kentucky's less. The commercials in this area on that basis pop I was talking about, I mean, they sold corn to the river. They sold corn in Ohio and along the Indiana-Ohio state line to the processors there. When you get a basis pop like that, and with interest costs where they are, the commercial truck house elevators they're gonna empty out of their stock. So they've definitely
We basically
responded.
took the carry out of the market, November 10th forward?
Yeah,
And by removing the carry, these commercials, they have no more incentive to store, so they just let her fly. And that they're going to try to reload here. I think Jan, Feb, March has been a very, very strong movement, and they've reloaded quite a bit. We see a decent carry in the delivery market, which determines your future spreads. It was there 15 cents from now till March in corn now. So that's flip-flop from late fall till now. We kind of didn't have a harvest push in November, early December, and now we're getting it all in Jan, Feb, March.
Yep. All right. When's your shot to move corn? So this is if you're tributary to the river. This is what I look at. So this is just export pace throughout the year. I mean, current 24 crop year is the dark line. 5-year average is the dotted line. So you can see our export inspections really pick up February into March, like through June, and then the safrinha crop comes off in Brazil here in July, and you can see we drop back off because now they're the cheapest corn in the world. So I've said for years as I worked down on the river, I mean, if someone had corn on DP at the river and you got into July, it's like, sell it or at least set your basis. Do not ride that unpriced into the middle of July because, I mean, basis at the river could go from 10 over to 40 under by August 1st because now the export market doesn't need U.S. corn or not much of it because the safrinha crop's off. So again, our big window is out through June, but you have some time on corn. We hit it aggressively because there was a hot basis pop in November, December, but in years where there's not, you got a good shot to lock in your basis on corn throughout the spring months as well. Beans is a different story. It's more front loaded, and we'll show that here in a little bit. Okay, then the problem with beans. All right, 22-23 world stocks to use was 27% on soybeans. Today it's 31%. I know that's only 4%, but 4%'s a lot when we're talking world stocks to use. That's a big change in beans. Look back at 1819 when we had 850 beans with the Chinese trade war. Stocks to use was the same, 30.8. So we're back in that same territory. It's just heavy. It's very heavy around the world. It's not good. Here's another way to look at it. World carry out to use ratio on the bottom, the orange line. You can see it's been growing again, close to 32%. It's the same as where we were in 1819. It's considerably higher than where we were 3 years ago. That's the problem with beans. That's the wet blanket that's over the bean market right now. The U.S. carry out to use ratio is above it. We've grown in the U.S. some, but not as much as around the world. It's, as we said before, Argentina, Brazil, they've had some big crops here. They've really grown the world carry out.
This year especially.
Yeah. Yes. This shows it versus price. So this is U.S. Carry out to use versus price. The price is the orange line here. You can just see it's an inverse relationship. Obviously, we were a little bit tighter here in these years. Price was higher. Now we've grown it back again. We're seeing price come back down.
It's also important to think when he was showing those stocks on corn, because it kind of looked goofy. It's like we're similar stocks to usage on the world market. Why aren't we closer to that mid 5-6 price versus now? Well, it's because of the bean market. When you got bean corn ratio down to 2.1, 2.2, the bean market is holding the corn market back.
Yeah, good point. I just threw this in there because it's a news story on beans recently. So Argentina crop condition rating, that was some of the headlines you saw last week. The bean market was higher last week. Some of it could have been due to this news. But you're hearing out of your contacts in South America that they're now increasing their crop size back up a little bit out of Brazil and Argentina right now. You want to touch on that real quick?
The concern is waning. The market probably traded it as low as a 46 million ton crop out of Argentina. Discussions with a couple of the big commercials and their head of research, who's a good friend of mine from when I was at Zeno. He's back up closer to 50 with increased potential based on how the rains are coming in. So, and then Brazil's in mid 170 crop. So just massive increase year on year in their South American supply chain.
Yeah. I mean, you look and the condition ratings do stink out of Argentina on beans, but I mean, they always seem to stink. I don't know if you
They're also very good.
Can you even put any, like, is there even anything to this? Should you even pay attention to these numbers? Yeah.
No, you talk to the people that you trust that spend the time down there.
All right. So we take a look at the November 25 soybean chart. So very erratic to say the least. We worked higher in early October up and touched $11 before we fell all the way to 960 recently. We were proponents early on of small sales in this 1080 range, like 10% is what we suggested and did some. The thought process there was the bean market looked ugly. World carryouts were huge. That was the first shot that we had after this dip to lock in somewhat of a positive return. I mean, I know it all depends on everyone's APH and their input costs and so on, but that was the first shot we had got it, a little bit of a return. So we suggested sales there. Hadn't done anything again since then. We think that we don't want to lock in a negative return to the business this early on, end of the story. So, if we get to a level where you can make a profit with APH type yields, I mean, if that's 1050, then I don't have a problem selling some more 1050 beans here. But for a lot of people, we hear cost of production, 1025 to 1075. I mean, 1025 is probably pretty light. It's probably 1050 to $11 for a lot of people, what we hear. So we're holding off on additional sales here. Seasonals are in our favor. Like I said, last year when I was standing here, 19 out of the last 21 years now, you've seen higher prices sometime in the marketing year than the January high. Doesn't mean it's going to happen again. But January highs up here at 1030. I guess we've already exceeded that. So it's already happened. But we just want to wait till we see some sort of positive return to the business if that happens going forward. And if we get that, into that 10.80 to $11 range, we're likely going to be suggesting, again, we'll see what way the wind's blowing when we get there, if we get there. But that's our idea for a price target here today. There are also ways you can add some premium to bean sales. I mean, it's not for every person, but like for instance, this 10.50 range, I mean, you could sell a 10.50 call option, and I think they're probably trading something like 60 cents, maybe 70 cents today, to get you up to above 11. There's no guaranteed sale on that. It definitely has risk. I don't want to get deep into that now, but that's always something we look at too with early bean sales with maybe one round of sales is, can you sell some premium while there's still some volatility value and time premium left in those. Large specs on soybeans, long 40,000 contracts currently, right in this range. There's just not a reason for them to want to get super long beans right now due to the world carryout being pretty comfortable. I think they're kind of getting drug along with corn. So
You got really bad crush margins in Brazil, Argentina, China, US. I mean, the world's awash in meal right now, which is really hard to create a bull bean market with a very weak meal market. The specs, I mean, they can read the S&Ds the same as we can, and there's no fear of running out of beans at the moment.
Okay, we'll take a look at the cash market for soybeans. So same map we saw for corn. This is total stocks as of the end of December versus 1 year ago. Locally here in Indiana, 15 million bushels more, so not much of a change. Ohio, 28 million bushels less. Shorter bean crop in Ohio due to some drought areas. And we've seen that in the basis. Cargill Sydney processing plant, they're 10 to 15 over for basis right now. In Bungie Morristown, they're 5 under, but they were 10 under about a week ago. So it's not that often you see a 20-cent spread between those two plants, but we're seeing that now because of the shorter bean crop in Ohio versus Indiana. On-farm stocks, not that different from the overall picture. Commercial stocks, similar to corn, commercials have liquidated their bean inventories. I mean, if you're a commercial and if you're a truck house and you fill up at 40, 50, 60 under in the fall under November futures, and you got a 15-cent carry to January, that's 65 under the Jan futures. If you can get 10 over, late November, December, and interest is at 8%, you move those out right away. So the commercial truck houses have moved out their beans. They have very, very little inventory. If the farmer doesn't sell it on basis pops, the commercial is going to engage at some point. And, and as advisors, that's something we'll look at and say, all right, at what point is the commercial going to hit this? Because you can't be bullish the basis forever. At some point, they're going to respond. And they did that late November, early December in a big way when we saw those post-harvest basis bumps. A lot of small print up here. I won't spend too much time on this. The point of this slide is to show that interest cost in holding soybeans is real. So I used 8% interest at $10 beans. That's 80 cents on a year divided by 12 months, 6.7, round up, call it 7 cents a month to store beans and not turn them into cash. So that, that's what we're looking at when we, if you talk to anybody we work with, or a few guys in the room that we work with, we set bean basis early this year, for last half November, December, January shipment, have the vast majority of the beans out already. And it's because we were able to get, 15 over, 20 over basis out of Bungie Morristown, and the river got up in that 15 over range as well. And so quick calculation on what that looks like. If you're like, well, I'm going to store beans till June to see if I can beat that basis. So basis sale executed on November 15th. We're 15 over the Jan futures. The spread Jan to July was a 35-cent carry. So that 15 over the Jan futures was the equivalent of 20 under the July futures. If we were to hold the beans to June, hoping for a higher basis, we would have accrued 47 cents of interest to carry those beans. So 20 under the July futures for a basis, plus 47 cents interest, we would have had to have beat a 27 over basis come June. Is it doable? Maybe, but that's a pretty darn good number. So I don't want to sit back and not sell any beans, hoping to beat a 27 over basis come June. I don't really see that as a strong possibility.
Not with a 300 plus carryout.
Yeah. Fast forward into the middle of December, got another opportunity at strong basis again. We traded some 20 over into Bungie Morristown for quick ship, and I think the river got in the 15 to 20 over range. The spreads had narrowed some by then to only a 20-cent carry to July. So 20 over the Jan futures is the same as even with the July futures. Interest cost was a little bit less then because the calendar had moved forward, 34 cents interest if you were to store to June. So on that date, December 18th, we would have had to trade the equivalent of 34 over the July futures for a June delivery, like to Bungie or somewhere. And again, that's a stout basis number. I personally don't see that happening. So again, that's why we are suggesting get the basis locked in. Let's move beans into this basis strength. So point of this slide again is that interest cost is real in beans, and definitely need to be looking at that when we're talking about what time of year do we ship beans, and is this basis level a good level or not. All right, when's your shot to move beans? If you're tributary to an export market, nobody's Jan. Brazilian crop starts coming off, late Jan, early February, and by March they're in full swing harvest. So that's why if you're tributary to a river market, we try to focus bean sales on December, January. Start with some corn, backfill with corn if you got logistic capacity on top of that. But then corn basis, as I showed before, that export window is more like March, April, May. So that's what we focus on. All right, then just a little bit of strategy on like when and why you should be setting basis at certain times. Really, it all comes down to what's the mass farm population doing? Are they moving it? Are they not moving it? What's it going to take to make them to move it? I mean, there's so much on-farm storage today. I mean, you guys know you can have a massive effect on what future spreads do and what basis does. I mean, this last fall, there were elevators in Ohio that didn't fill their space. Some elevators in Indiana didn't fill their space. When basis got so wide, got 55, 60 under, I mean, you guys did what you're supposed to do. You found places to store it. I heard from some people, Tara, one of our colleagues, lives in Fort Wayne, and she said on the drive from there to Indianapolis, she'd never seen as many grain bags out in fields as she had this year. So you guys responded to these weak basis levels, and you got creative on putting it in flat storage, putting it in bags, et cetera. But my thought process on basis is when everyone else is zigging, we want to zag. So harvest got done this year, and it was a flurry of harvest got done a little early. And I imagine most people were tired, didn't want to move grain, right? You just put it in your bin. And we saw that basis pop in late November, December. So when everyone else was zigging, which I mean by zigging, not delivering grain, what did we do? We wanted to zag, right? We saw that strong basis pop, and we wanted to sell into it. So I just try to think about what are some things that make movement slow. You get like a post-harvest break in November, December. That's typically a good time, a lot of years, to look for a basis pop to sell into. If farmers don't need cash flow, they're not going to move it. And they didn't really need cash flow too much in November, early December, but we figured by Jan, Feb, March, they'd need a lot of cash flow. So we wanted to get ahead of that. Some other things are going to slow movement, obviously planting season, or if you get like a river freeze, things like that, those are other opportunities for a strong basis. But what we want to avoid, there's mass movement, Jan, Feb, March, that's the new harvest, right? That's when there's big long lines at all the terminals. So we want to, if we expect big Jan, Feb, March movement like we did this year, we want to get basis set ahead of that time frame. A lot of cash flow needs Jan, Feb, March. Round price targets also, we got out of harvest and it was like, people aren't going to move corn unless we hit 450, or they're not going to move beans unless we hit 1050. And the futures market wasn't getting us there. So we had a basis pop. And again, we sold into it because we thought it was going to take those round price numbers for farmers to engage on movement. Okay, wouldn't be a market update unless we talked about wheat for 30 seconds. So here's wheat. The carry out to use ratio on wheat is, dare I say, somewhat interesting right now. Major exporters carry out to use ratio is at 14%, and this is the lowest it's been since 2007. So it makes me want to be bullish wheat from these prices. Nate, what's your feedback on Black Sea wheat? We keep hearing from the Russians that their crop was hurt, but yet they keep offering wheat to the world cheaper and cheaper, and they still have more to export. So what the heck's going on there?
You got to remember, most of the world doesn't have a USDA, so their crop size, their crop estimates, you got to take them all with a grain of salt. The only way to truly understand how much they have is either export inspection census numbers of what they push out of the country and how their internal basis trades. The Russians have a massive incentive to ship everything not tied down because they are desperately in need of foreign currency reserves. So they are shipping all the wheat they can get their hands on. They're probably stealing it from Ukraine and shipping it. Ukraine's been doing the same thing. So yes, they definitely had a lower crop year on year, but they have found a way to merchandise that entire crop. EU had some crop issues, some quality issues. They're feeding wheat again. Well, they always feed wheat, but they're feeding it versus corn because it's the corn wheat spread is narrowed enough that it's cheaper. And so you've got this goofy setup where you've got a narrowing stocks to usage, you've got the funds short, and you've got what should be a fairly bullish story, but we just can't get it to engage because the Russian offer on the world market continues to undercut the rest of the world prices. And where Russian prices go is kind of where world wheat prices go. And until that whatever ceiling is lifted and they can't offer anymore, the wheat market stays subdued. So there's a lot of analysts that think February, March, Russia could be out, needs to remove themselves from the market, and that would let the market float again. Personally, I think that's a high possibility. China, I think, had some flooding issues in the south. They are an importer of wheat when that happens. So it's a potential trade settlement that they could offer to the US, and at the same time, they were going to buy it anyway. So there's a few things in wheat that tell me to be patient if you've got wheat in the field and growing. But it's wheat. It's a really, really tough trade, especially from a flat price standpoint. The funds are comfortable because the carries are wide. They can roll those shorts forward and keep picking up that carry. And so we're going to need to see the cash prices in the US start to find a bid. We're going to need to see Russian prices find a bid. Then you can start to change the narrative of what flat price wheat needs to do.
All right, appreciate that. Wheat chart here. Okay, this is July of 25 futures. You can see back last year we had a rally in wheat May into June, and personally we stepped out and sold some 25 wheat there. You know, as usual, you always start a little early on the rally up, right? So, you know, 650, 660 type range. We started engaging, you know, when that happened. It was bumping up against some old resistance, you know, and had quite a rally from $6. So we started engaging there. And then again, $7 plus continued to suggest sales. You know, we got to half sold for most customers on wheat, you know, with call it a $6.80 to $7 average. And then since then the bottom fell out, had another little opportunity here in October. I mean, personally, I didn't suggest any sales there. It just was, I guess.
We got
Didn't
far
think it
enough
was-
along earlier that it's hard to push it.
Yeah, exactly. I mean, if we were already half sold with some people and, you know, it was this early on, didn't really want to push it any further. But it had about a 50% retracement before the wheat fell out of bed again. You can see it's just struggling to do much of anything. So like Nate says, it's geared up. If something were to get a little spicy with the funds pretty short, we could get a pretty volatile move higher in wheat, but it's just not happening so far. So we're being patient. Seasonals do show that wheat moves higher tend to happen in that April, May timeframe. So we'll sit on our hands for now and see if we're fortunate enough to have that happen again here. Okay, that pretty well covers it for what we had. Guess I'll open it up. You guys got any questions? Anything we didn't cover here? You Want to drill us with here?
I'll start. We've heard a lot of talk about sustainable aviation fuel playing into the market. Where are we at that today? Is it gonna be a player or not, or what's sort of our budget?
I think with the current administration, it's going to have to find its way in from not only an economic standpoint, but a energy efficiency standpoint. Drill baby drill is kind of the talk of the day, right? So the green energy programs are probably going to take a back burner. They live and die by government subsidy only. Without government subsidy, they are completely unviable. And so today I don't see it as a major fundamental influence in the market at all. The plants that are out there, I think the one in Atlanta is using Brazilian sugar, or Brazilian ethanol from sugar to make it. And that's really about the only. I don't have a lot of information on it. It's just not on our radar right now. And it's even less so as Trump has taken office, and you kind of read the tea leaves of what DOGE means and what those programs have been built on. I attended a conference this last summer, and I mean, it was all the big dogs in RFA, Green Plains, SAF manufacturers. The only thing they could talk about is what policy, what subsidies they're going to get. None of it had to do with here's the demand, here's how we make it cheaper. I mean, if you're running a real business, if you're living and dying by what the stroke of a pen in Washington means, I'd be really nervous about my job. And I think that was the takeaway I had from the conference is, yeah, we could sit there and spreadsheet out how much demand it could create, but every gallon we produce, the taxpayer had to pay for. And I don't get the feeling that's the motivation right now.
You think our current ethanol structure is at risk?
She says it isn't. The new whatever department that is says she is willing to maintain the current status quo there. I don't think they'll shake that up too much. That market's going to have to grow via exports. Brazil has found ethanol to be very economical, and they are making gobs of ethanol and growing their business tremendously down there. They were already 80-90% because of sugar ethanol. They're going to start adding corn ethanol. Brazil's also increased their feeding. So while they're growing their corn crop, they're also using a bunch of it domestically. My concern is a bushel of corn in Brazil is much cheaper than a bushel of corn in the US. And if they're going to build out the ethanol, more than likely it builds out in the South. But that removes corn from the export market. So it's not all is lost. If I was investing money in an ethanol plant, I don't know that I would do it on US soil today. And I don't think we're going to see a lot of investment expansion in that industry right now. You got to ask about bean oil. I have no idea. The bean oil is very similar. The 45Z policy looks like it's DOA. They're just not going to subsidize anything. So now the plants have to become more, the RINs have to be generated via the current structure. I don't know how much growth that means for bean oil. The real problem right now is if bean oil is going to get a bump, it's because meal's gotten so cheap, they're throttling plants back to run their crush plants at meal disappearance levels. That's kind of the story today, especially when you got Argentina offering meal at negative unders, fob their coast, where, I mean, we're still trying to trade in the overs. So U.S. export meal is not going to happen. So we'll see U.S. plants should start throttling back Feb, March, April. And even Argentine plants are talking about throttling back. So the bean oil story, it could get another life. I don't know what negotiations, but we're not doing it based on raw supply demand fundamentals. It's demand created via government policy. It is how that will have to happen. And I don't have an edge in that.
So I'm curious from an acreage standpoint, we've heard both sides of the story. Corn pencil's better than beans, so I see a little shift to corn from folks. And then the other side of the story is that it costs more to put out a corn crop and extra cash has been tight. So some people are leaning heavier towards beans. I don't know which one offsets the other. I don't know if anyone has any feedback on what they're hearing or seeing. I know in our part of the world, we pretty much stick close to rotation. So is that the answer, or is anyone here and seeing a shift out there? Yeah. Okay.
Is there a price relationship that changes that? Like the market likes to trade corn bean ratio, right? But I guess answer the question first and I'll pontificate on that.
I think booster level, I think that interest rate changes it more than anything. I'm not saying it's right. That's probably not the way it should be.
It's logical.
If you run your numbers right now, it's, well, in my opinion, if we're going to continue to invest money in gas and fast, yield still king, but when you get looking at taking 80 averages to break even with the next good year.
I'd say it's probably pretty good statement. Interest rates probably feeds into that. And I would say nitrogen cost probably feeds into that as well.
Sure.
Yeah, which once again, that's part of why the corn is looking so good. It's nitrogen has been so much better.
Yeah. We've seen a bit of uptake in part of the fertilizer profile on corn was it last week, she said?
Yeah.
But for the most part, it's kind of flat year on year, which I think would lend you more to the corn side, especially the ratios popped a little more than I would have expected it to.
Other thing to play into this is spring.
Oh, of course.
Yeah. Yeah, the current height, what's the current ratio? Is it new crop? Is it
It's 2.2 now.
Two, it's 2.2,
Yeah.
2.3? Okay.
I don't.
So that's kind of midline, right?
Yeah, I mean, we were in discussions 3 weeks ago. Should it go 1.9 to 2?
Yeah.
I mean, it just looks so bad, and then you start to get up in these upper ranges. That USDA report changed a lot of how everything looks. So the back of my mind, it's like, man, this is a gift I did not see coming, and we've got to work our way through this and not get complacent. And I was telling the story to Rick here before we started. I mean, through the weekend, I don't know how close you watched the news, but this little spat with Colombia could have been disastrous. If we put on tariffs to them, they retaliated tariffs on corn, beans, meal, their imports. All of a sudden, our third largest buyer of U.S. corn, who's got a ton of sales on the books, is saying, I'm not buying from you anymore. And Argentine corn's coming off, Brazil's corn's coming off in a few months. They would have bought some because they have to. They live about 35 to 45 days of supply. But as they got to the end of that supply chain, they're going elsewhere. Mercosur agreement or not, you start throwing tariffs in there, everything changes. And that could have been disastrous for the corn market from an export side. Really more so for like your front month basis, the next 6 months basis could have got smoked.
So my takeaway from that is that right now, with the current administration, the volatility of or the unknown of policy risk is a lot greater than it was 6 months ago, 12 months ago.
You go back to 2000, what was it, 18, 19. As a trader, trades for a living. That's how I make my money. That was the worst 2 years of my entire career, because you go home on a Friday and think, okay, here's what I'm looking at. Risks are within these envelopes. Oh, we got to deal with China. We're going to buy 20 million tons. Corn's up like 30, 40 cents. I said, nope, no deal. Back down. It's it's a nightmare. And so money starts to leave the market or go off on the edges, and you get your swings get wilder because there's less participants. So the volatility increases, and it's just really difficult. And so you kind of ground yourself in the fundamentals, stay out of high risk positions, You get basis like we were talking about earlier. You get basis in 5 to 10 over at Ohio River. That equates to about a 10 over, 11 over Illinois River, which is about as high as corn basis goes before the spreads take off. You just lock that in if it's at the start of the shipment window. That's a no-brainer from a cash trade standpoint. You just do those things and you got to ignore the noise. There's nothing you can do about the noise when it's government policy. But my fear is we are going back down that road in a large degree. I mean, if he's willing to tariff Colombia, which is in the grand scheme of things, the United States, not a big deal. But for our little world, it's a huge deal. But he was going to tariff them over 2 planes of immigrants not getting allowed in. So that's a weapon he's going to quickly. I think the takeaway is don't look a gift horse in the mouth. If you've got decent returns to the business, you can do some things, whether it's min maxes, like the sold call thing on beans, where you leave yourself some windows, but you got to start taking some cake as it gets passed around, as we say. And you could be smart. If everybody sits back and waits and he negotiates a deal with China and they're back to the table, Christ, we could beat $6 corn, but we got to get something like that to happen.
Well, I guess that's a kind of a good segment of the key points that I heard. You know, there is a lot of support of corn today in the market.
Huge.
And we've got opportunities to sell, we've got opportunities to sell in the black. $5 corn's not a possibility. We may need to work our way into it, it sounds like. So take those opportunities when they exist. Beans are tough. You know, beans are tough, capitalize when we can then. You know, watch those margins and understand your input costs and know where you gotta be at and pull it through when you can. And sooner's better than later, right? Let's not hold soybeans too late in the summer, it's not like, so. I like the basic strategy, the zigzag, you know, and you know, we utilize that with you guys as those opportunities, you know, capture those and move them and pick up those pennies when you can. So,
Yeah, it's really simple, but I try to separate basis and futures as much as possible. Sometimes it just makes sense to sell cash, of course, there's nothing wrong with that, but you know, probably 75% of the time it makes sense to separate basis and futures timing of sales if you can.
we've been on operations. Pretty successful. So, does anybody have any questions? Listen, you guys be around through lunch anyway, we can grab one of the guys. If some of these guys want to get a hold of you, you got your contact information you can share with them?
Yeah, my email's right there, travis@interactiveag.com. So yep, if anyone has any questions they want to ask us, feel free to shoot us something.
Yeah.
Yes, your numbers.
Yeah, sure. Yep, you bet.
Anything else, please, guys?
Thank you.
Yeah, thanks bunch. Appreciate the opportunity.
Yep, thank you guys
Yeah.
for coming. Spencer's been all evening slating away on Zoom. What we got today? Dumbo and chicken for so. Himself, we've got plenty, so hopefully we can do it. So thanks again. Thank you. And we'll be around.
I think that's the first time